The ultimate dream is to earn money without doing anything at all. Now, I'm talking about generating legitimate passive income. Now, I can't begin to sit here and just share with you how many fraudsters are out there telling you to do any numerous amount of their side hustle ideas to retire by 23 or become some type of millionaire by Tuesday. And no, I'm not here saying that all of their ideas won't work, but I am saying that there's an easier way, a way which truly requires minimum effort. Maybe a couple of clicks here and there per week, but that is just about it. With that, are you ready? So I don't want to sit here and lie to you. This approach will take some time, but as I always say, it pays to be patient. That's patient with a Y. Now, naturally, as an investment channel, I'm going to go ahead and talk stock market to you. More so, I'm going to simplify it all down for you and just ensure that minimum effort is really required on your behalf. And I want to start then with this notion of beating the market. Why? Because so many of us try to do it, and far too many of us think that to even get started, we need some perfect plan to beat the market, or else we're going to be left out of luck and just left empty-handed with depleted bank accounts.
You'll be losing money. In other words, the dividend gain is not worth the principal loss. Whoa, I can't take the pain.
However, we do need to come around to the understanding that literally everybody tries to beat the market, but very few actually succeed. Now, in order to beat the market, an investor would simply need to earn an investment return that exceeds the performance of the Standard & Poor's 500 index, or better known as the S&P 500. And no disrespect now to some of the market's best and brightest, like Lynch and Buffett, but some years they have just been insanely lucky. Because as the rumors have it, or at least as studies have shown, sometimes portfolios of totally randomized chosen stocks can perform just as well, if not better, than assembled Buffett or Lynch-backed portfolios. Meaning, there really are no market wizards out there, so just don't be afraid to start. But where? How? What exactly does minimum effort even look like when it comes to investing in the stock market? Well, that's exactly where exchange-traded funds come in. And today, I have 4 to pick from to ultimately invest into, and as long as you do it for life, or at least consistently, for what we in the biz would call dollar cost averaging in on a consistent basis for your golden years, you're going to be set. Now, most importantly to note is just the fact that each one of these funds tracks the S&P performance. So it's that good old, if you can't beat them, join them approach. With that, we have the iShares Core S&P 500 ETF, ticker symbol IVV, up first, which, spoiler alert, has the lowest expense ratio, which I want to cover why that's so important in a moment. But before I do, I want to go ahead and get to the objective of this fund, which is to track large cap US equities with tax efficiency, and it's recommended as a core position. Now, we'll get to the exposure of this fund here, weighting heavily in the tech sector at 29.56% of the fund's weight, followed by financials at 12.88%, healthcare at 12.6%, consumer discretionary at 10.5%, and communications at 9.12%, with holdings like Microsoft and Apple coming in as the fund's largest positions, followed by Nvidia, Amazon, Meta, Google, Berkshire Hathaway, Broadcom, and Eli Lilly, totaling out to 503 holdings, while of course also paying a chunk of a dividend on a quarterly basis, coming in at 1.44%. Now, performance-wise, this would all mean that if you invested $10,000 10 years ago, that would have morphed into $33,235.34, all for the low cost of just $3 per $10,000 invested with that expense ratio. Now, what's the deal with this fee, and why does it matter? Well, first, nothing in life is free, so you'll make money, but you gotta pay out those who helped you make the money. And something now that's incredibly important to note is the fund's expense ratio when it comes to any ETF, because it can significantly impact a long-term investor's total return. So let's just say we have an investor who invested $10,000 into a fund that returns 10% every year. Now, he'll pay $336 in fees with a fund that has a 0.5% expense ratio. Now, if that same investor invested that $10,000 into an alternative fund at 2.5% of an expense ratio, he'd pay $1,682 in fees. All I'm saying is be smart. And in being smart, you may find yourself now investing into this next fund. It's Vanguard's S&P 500 Index Fund, ticker symbol VOO. After all, it was Vanguard's founder, John Bogle, the father of index investing, that remained steadfast about investors avoiding unnecessary fees. Anyhow, this specific Vanguard fund's goal is, of course, to closely track the S&P's index fixed returns while offering a high potential for investment growth. The ETF will grant you a ton of exposure to tech, 28.9% of the fund's weighting in the tech sector before covering the financial and healthcare sectors at roughly 12.9% and 12.6% respectively, followed by the consumer discretionary sector at 10.9% and industrials at 8.8%. Whereas the total holdings work out to 505 holdings, with the top positions coming down to Apple and Microsoft, followed by Amazon and Nvidia, Google, Meta, and some more Google, Tesla, Berkshire Hathaway, and JP Morgan. Now, you will also receive a quarterly dividend with the yield coming in at 1.39%. Performance-wise, if you made a $10,000 investment into VOO 10 years ago, you'd now be sitting on $34,110.86 and only be charged $3 per $10,000 invested annually. Now, investors, before I go ahead and cover this next S&P ETF, I want you to put some effort into actually subscribing to the channel and joining me on this financial freedom journey this year to smash our financial goals together. And while you're at it, if this content is of value to you, let me know by tapping on that thumbs up button, and I'll continue to make more content just like this. With that, let's go ahead and talk about the State Street Global Advisors SPDR Portfolio S&P 500 ETF, ticker symbol SPLG, which you might be able to guess it by now, seeks to track the actual results that correspond to the total return of the S&P, obviously. But this ETF is really a great option for the building blocks of a standout portfolio with 29.61% of the exposure in tech, 12.92% covering financials, another 12.63% worth of the fund's weighting covering healthcare, while consumer discretionary comes in at 10.51%. The fund's weighting and communication comes in at roughly 9.14%. Now, once again, we find Microsoft and Apple as the top two holdings, with Nvidia, Amazon, and Meta following suit before Google, Berkshire Hathaway, Broadcom, and Eli Lilly enter the picture. And right off the bat, some good news. With a 0.02% expense ratio, working out to only $2 per $10,000 invested annually. Let's talk about the performance here, because it's also including a 1.39% dividend yield paid out on a quarterly basis. But that $10,000 invested 10 years ago, well, you'd now be sitting on $33,341.47. And then we have what I think is the most well-known S&P 500 investment, also a State Street Global ETF, which is the SPDR S&P 500 ETF, that's ticker symbol SPY. Launched in 1993 as the very first exchange-traded fund listed in the United States and remains the most liquid S&P ETF. Now, liquidity just means how easy it is to buy or sell an ETF based on the cost of trading. Many of you likely won't be trading, but for some active traders, this would be the ideal ETF. And it would grant you plenty of exposure, just like the other mentions here today, to information technology with roughly 29.63% of the fund's weighting in tech, 12.91% financials, 12.63% of the weighting in healthcare, 10.52% consumer discretionary, and 9.14% communication services, all working out to Microsoft and Apple as the largest holdings in the fund, followed by Nvidia, Amazon, Meta, Google, Berkshire Hathaway, Broadcom, and Eli Lilly. Now pay attention here, because it actually has an expense ratio working out to be 0.0945%, meaning nearly $10 per $10,000 invested annually, a lower dividend yield at 1.31%, but these 503 holdings would deliver through on performance. A $10,000 investment made 10 years ago would have turned into $33,886.15. So really, all of these funds you can't go wrong with as core positions in your portfolio, as long as you're dollar cost averaging into them on a consistent basis for life. Now let me know which ETF you own as your core position. Comment down below, subscribe to join me on this financial freedom journey, and catch more insights right here.